The national portion of the life insurance exam requires a deep understanding of the differences between joint life and survivorship life insurance policies. On the exam, you will often see questions designed to confuse these two because they both involve covering more than one person under a single contract. Joint life insurance, which is also commonly referred to as a first-to-die policy, covers two or more individuals and pays the death benefit when the first person in the group passes away. Once that first death occurs, the policy pays out to the beneficiary and the contract terminates completely. This means the surviving person no longer has coverage under this specific policy and must find new insurance if they still have a need. From an exam perspective, you need to know that joint life is most frequently used for mortgage protection or business buy-sell agreements. Imagine two business partners who want to ensure that if one dies, the survivor has the funds to buy out the deceased partner's share. A joint life policy is perfect for this because it is more cost-effective than buying two separate policies. The premium is calculated based on a joint average age, which typically results in a lower cost than two individual whole life policies. A common trap on the exam is a question asking if the second person is still covered after the first death. The answer is always no, because the policy is fulfilled and finished after the first claim is paid. Survivorship life insurance, which is often called a second-to-die policy, also covers two or more lives, but it pays the death benefit only after the last person insured dies. This means that when the first person passes away, no benefit is paid at all. The policy remains in force and the survivor continues to be covered. The exam will heavily link survivorship life to estate planning and the payment of federal estate taxes. Because the death benefit is deferred until the second death, it provides immediate liquidity to an estate when those taxes typically become due upon the death of the second spouse. You should remember that the premiums for survivorship life are generally lower than those for joint life or individual policies, because the insurance company is essentially betting on the fact that it will take longer for two people to die than for just one. A classic exam scenario involves a wealthy couple looking to minimize the impact of estate taxes on their heirs. The correct answer in that scenario is almost always survivorship life. To keep these straight in your head, use the mnemonic, joint is just for the first, and survivorship is for the second. If you see the word joint, think of a joint checking account where either person can trigger the action, but for the insurance, it only triggers the payout once. If you see survivorship, think of the person who survives the longest. One major trick wording you might see is a question asking which policy would be best for a young couple who needs income replacement if one spouse dies. The answer there is actually individual policies or joint life, because survivorship life would leave the surviving spouse with nothing to live on. Another high-yield fact is that survivorship policies are sometimes easier to issue if one applicant is in poor health, because the insurer is not concerned with the timing of the first death. Always look for keywords like estate taxes for survivorship and business partners or mortgage for joint life. By focusing on the timing of the payout and the specific financial need, you will be able to navigate these questions with total confidence on exam day.